Destin, Mobile, Santa Rosa Beach, Gulfport, Pensacola, Biloxi, and of course, our home base of Fairhope, Alabama. Welcome to Wealth in Waves, a show dedicated to all you busy folks out there making it happen. Join me, Josh Null, my co-host, Will Steih, as we take a deep dive into how to build wealth, how to protect wealth, and how to have a little fun enjoying that wealth along our beautiful Gulf Coast. If you're a busy business owner, entrepreneur, sole proprietor, or maybe just a successful professional and you're plugged into your work, your family, your faith, and the Gulf Coast lifestyle, if you're all in on life, then you have found your show. So before we get started on our topic today, I want to introduce my co-host, Will Steih. He is a licensed CPA and a fellow financial advisor, works with us down here in the Gulf Coast Financial Advisors. Will, how you doing?
Josh, I am doing outstanding. I've enjoyed the last couple of days here on the Gulf Coast, to the point of what's going on is some fishing, some boating, some food, just a wonderful couple of days spent with my oldest son, Jack, and enjoying the Gulf Coast lifestyle.
That's right. We try not to time date our podcasts and our recordings and things like that, but we're emerging into a beautiful spring. Summer's right around the corner. Everybody's getting out in their boats, fishing. It's really starting to get, it's always enjoyable down here, but it's really starting to kick in. Well, Will, what we're going to talk about today is something that you've got quite a bit of experience with, and is actually you're the one that introduced it to our practice, Gulf Coast Financial Advisors. It's a particular concept called cash balance. Some of you all that may recognize that term or loosely recognize that term will know it as a defined benefit plan. Now, I promise we're not going to get super nerdy. We're going to keep the cookies on the lower shelves, as Will likes to say, but we're going to build this thing up from the bottom. We're going to tell you what a cash balance plan is. We're going to give you some examples of where it might be something to consider. And we're going to run through just some kind of high level numbers to let you see let's say the pros and cons of doing a cash balance plan. So Will, as we jump in, what I want to ask you is can you tell us what is, in your words, what's a cash balance plan?
Cash balance plans are a sort of third, fourth generation from an original pension plan design. So whenever people think of a pension plan, they think of a Fortune 100 company where at the anniversary retirement party of the 25-year plus employee, they perhaps hand them a gold watch. In addition, gave them a commitment that said, listen, we're going to pay you for the rest of your life a pension that's going to help you retire and hopefully retire well. So cash balance plans are what I would say was the modern day version of the pension plans of 30, 40, 50 years ago.
Right. And also too, as someone that has been self-employed since my early 20s, I can tell you one of the decision-making processes that would have definitely been on the detrimental side, if you would, back then was, man, I'm walking away from like any future income security. I'm old enough that pensions were still kind of a topic of conversation, and we definitely thought about it. So I want to ask you is, can a self-employed person view this as, hey, I have my 401k, I have the value of my business, but is there an opportunity for me to set up something that maybe I saw my mother or father enjoy, or maybe my grandparents in kind of a pension type environment? Is that where we're going with this?
Sure. You make mention of 401k. So again, in defining cash balance, let me qualify who does this apply to. For business owners, busy professionals, those who actually own their own company, those who are either that or a partner in a firm with other owners that have a similar mindset. These are owners that have already established a 401k plan previously. They're making contributions on behalf of themselves and their employees where that applies. This could also apply to a one owner or one employee business called them a solo. But let's take an example of a professional organization. It could be a law firm, accounting, maybe it's a dental practice or a surgery group. And we're already making contributions on behalf of some employees. Oftentimes we'll refer to that to safe harbor plan. They've already taken steps to help establish a retirement program for their employees and certainly for themselves as well, because they are also a participant in those plans. But what's left on the table is they still have an appetite for more savings. They have a desire to say, listen, if I'm in the neighborhood of a $400, $500, or $1,000 or more of taxable income, I'd really like to save more because, quite frankly, what the IRS limits you on is roughly $60,000 in a 401k plan. If you're contributing $60,000 a year at the age of 50, trying to replace $500,000 of income, it's only going to take you so far. That's barely over 10% of the amount. So a cash balance plan, if you think of it this way, you're going to raise the ceiling on what's permissible under the tax code. And this is why the connection back to The historical pension plan applies because those are the same tax code, same rules that we're using, and we're going to go ahead and consult with a client and help advise them as to what the capability is. Just how high is the ceiling? We can talk more about that, but ultimately, we're trying to help the owner save more for his or her future.
Perfect. And Will, what I'm hearing you say, and from our experience working with these type of plans and these business owners, is a cash balance plan is something that is layered on top of an existing 401k plan that is already being fully funded, hasn't been neglected. It's actually has been put to use. This is a way to go above and beyond potentially with additional dollars dedicated towards retirement, right?
Correct.
Right.
The first step is to make use of those tools that are already available. Generally, I would say you'd be hard pressed today to find a company, and perhaps it's early on in its stages of its life cycle. But for most mature professional companies, they've already have a 401k plan. So the first step is fully fund, fully maximize what that 401k allows for.
Which, and to be fair too, we can always do that from a startup standpoint as well. But typically when we're coming to this is a mature business owner. They've got a long history, or at least a relatively long history of cash flow, profits, taking care of their employees. There's some boxes that we're going to check to make sure that they're good before we really dive into this thing. The other thing too is, we deal with some pretty sophisticated clients, particularly those ones that have served as a plan sponsor. And one of the things that I almost guarantee they're going to be thinking is, well, in the 401k guys, I've got to treat everybody equal. You're telling me that I got to layer something above and beyond that that's considered qualified, and I got to go equal again. How does that actually benefit me?
Great question, Josh. And that's where, again, using what the rules are in place. This is black and white in the code per the IRS. And so it's a function of a consultant in our case. We're going to advise the client and help navigate through that. We're going to engage an actuary as a part of our team to make sure all the I's are dotted and T's are crossed. But to the point of making sure that the percentage of contribution, so the employers used to, hey, if I put $1 in for me, I got to put $1 in for everybody else, the non-owners. In the case of a cash balance plan, the rules will allow for the owner, because typically the owner is going to have a greater dollar compensation than anybody else in the company. We are able to be more efficient. So I'll give you an example. So if in a cash balance setting, I was talking to a business owner, he or she, and I said, you have the ability, the next dollar you put in this plan, at least 80 cents of the dollar will come back to the business owner, or perhaps the business owner's spouse or partner. That really gets the business owner's attention to say, oh, this isn't the same thing as more profit sharing. This is actually going to help the business owner extend and create more savings for themselves in the future. And again, this is going to be a tax deductible contribution, which really helps out when you think in the long term.
Well, Will, what I'm going to do is, based on our experience together, I'm going to outline kind of an example of where I think that a cash balance plan should at least be a concept to consider. And after we outline that too, we're also going to talk about maybe some of the downsides, if you will, some of the things that you got to be ready to commit to, that once you commit to them, there's really no turning back. You're running down that road. But from what I can tell, in your opinion, what do you think a company size, at what point does it become a little prohibitive maybe to look at a cash balance plan? 10 employees, 20 employees, 50 employees? Is there a magic number? What do you think about that?
Sure. Terrific question. So I actually just have a situation right now, trying to help another advisor think through it. Got a company that's actually making a 6% of pay contribution on behalf of the employees already at the company. So obviously over time, however it's come about, it's a big initiative by the employer to try to help the employees save for retirement. So let's say I've got an employee making $50,000 a year. The employer's already committed 6% contribution. That's roughly $3,000. That's a hefty contribution when you look at the numbers and the demographics around 401k plans. It's probably twice what the normal average would even be. That's a great opportunity for that employer. You're already essentially spending 6% to get into the realm to be able to implement a cash balance plan. It's going to roughly cost you somewhere in the neighborhood of 7%. So when you think about this, 7 minus 6 is for an extra 1% of payroll costs. They can incorporate this cash balance plan in order to raise the ceiling, again, use that term, raise the ceiling for the employer or employers if it's a case of a multiple owner situation. And that's a pretty good bargain. So first of all, I would say it's more so, are you currently contributing on behalf of your employees, and to what extent are you contributing? And then I'd also say there's going to be a limit. So you ask in this case, it's sort of like a head count. I would generally say that if I have a business with less than 50 employees, this can be a viable concept. Once you go beyond 50 employees, that's where we start to ask ourselves a question. Hey, for every dollar, you got to consider, let's say it's 100, 150. There's quite a few people in that mix that you're going to have to make a contribution for. That's where it does become cost prohibitive.
But let's use examples of cases that we've worked where we've had 10 employees, 20 employees. Typically speaking, when you have 10, 15, 20, 30 employees, there's usually a couple of people that are considered kind of your key producers, right? Is there a way to use a cash balance plan to not only serve as a vehicle to fund additional retirement income needs for the business owner, but is there a way that you can use that with the rank and file and maybe some of your higher producers as kind of as something we're going to talk about on a different podcast, but as kind of a key person incentive? Is it allowed to do that?
Good question. What's interesting about that is you could do either or. In the case of once I've satisfied the regulations around the non-highly compensated employees, and when we talk about highly compensated employees, we're talking about those that are earning more than $130,000 or more W-2 compensation, that it's that group, the highly comps, those that, as you point out, necessarily could be maybe the key salesperson or the key operations person, somebody in the organization that's really putting their shoulder to it, making a contribution. You could go either way. Once you've satisfied the non-highly compensated, you could treat your highly compensated with some disparity. You could pick and choose. You could say, you know what, this person's been with me for 10 years. I feel like they're going to stick. They're going to be around a while. This other person's only been with me 2. We'll wait and see. Once you've satisfied the non-highlies, then you could take some discretion either to do more generous contributions for the highlies or go the other direction, say, hey, we're going to take a wait and see attitude.
Well, let's talk about one more component of it, and then let's do a little pro and con kind of thing. And how I want to do with this, Will, is I want to tread into this carefully because I don't want to give everybody the impression, somebody listening to this saying, man, that sounds perfect. And now I'm about to give you kind of a concept that goes along with the cash balance, and that is potentially using life insurance as part of the funding mechanism inside the plan. But I always want to be careful there because a lot of times people will say, yeah, we'll throw some life insurance in there, but there's no consideration for the underwriting requirements, right? So it's really one of those things where, one, I want to talk about on can we use life insurance inside the cash balance plan? And if so, what does that look like and why would you consider doing that? So I'll kick it to you on that.
Josh, that's an interesting, in situations where it makes sense. Again, this is one of those cash balance plans and by their design. I've looked at just about everything in the last 20 plus years of being in the industry. I've seen so many things come across my desk and so many different concepts, ideas, strategies. And basically it's entirely focused on trying to place an insurance policy rather than trying to solve for the challenge that a business owner faces. Our use of a life insurance policy would be limited to those situations where we have a business owner. First of all, it qualifies. Certainly that's a consideration. Medical underwriting. The other aspect is financial underwriting. Is this something that's going to be feasible and work for the good of the business owner, he or she? And quite frankly, we're using it as a Roth alternative. Right. We're actually looking at it from a standpoint of, if structured properly, incorporating a very specially designed life insurance policy. This is not your grandfather's whole life policy for sure, but it's a specifically designed policy in order to create tax-free distributions upon retirement. So imagine it like a super Roth, basically. In some cases, I had one business owner kind of exclaim, understanding and revealing this to them. And so over time, that particular piece can be incorporated. Now, here's the good news. The good news is people are typically used to, hey, I've got this life insurance policy. Somebody sold it to me. I think it's what I'm supposed to have. I'm not really sure. But all of a sudden they say, I'm using after-tax dollars to pay those premiums. What gets people's attention is the tax code does allow for there to be a life insurance policy owned by the plan itself, owned by the trust that's the plan's incorporated into. So what that means is let's say I'm putting $1 premium in the plan, that's actually probably net savings like 60 cents after tax. So basically 40% in today's income tax brackets, 40 cents of the dollars that the federal government are now contributing on behalf of the business owner towards the premiums of a policy.
Very good. All right. And Will, one point I want to make on that to wrap that part up is, one, you said Roth alternative. So for the folks that we are targeting or they're listening and considering having a cash balance conversation, you're not going to qualify for a Roth anyway. Your income's going to be, you would have probably passed that stopping point at some point in the past of your career. So this is one way for you to maybe get some Roth-like treatment in some of your investments where you don't have access to anymore. Number two is, what you and I have really dug into these things. It's a case-by-case situation with using life insurance. And the one thing that I think, I really want to make clear is One, you're only going to use life insurance to supplement the overall plan. It is not intended to hoover up every dollar by any stretch. It's going to be a lesser percentage of the overall plan. And two, if you're getting a cash balance plan, you need to understand that on the investment side, the advisory side, it's not going to be a very exciting ride. I mean, they are specifically designed to be pretty conservative, right? Yeah, you're trying to hit a number because remember, defined benefit, defined contribution, your 401k, you know what's going in, you may not necessarily what's coming out. Defined benefit, on the other hand, is you're targeting a specific outcome down the road. And so to get that specific outcome, you got to kind of control the inputs a little bit and conservative growth to get to that point. So Will, I got one more thing that I want to let's do this. Because this is going to be Wealth and Waves is an open show, open discussion. We're not here to give one point of view. We're not here to sell anything. We're here to chop up these topics that apply to our particular target market. So, in my opinion, on the cash balance plan, if you check a lot of boxes, like we outlined earlier, you've got the 401k that's been, really been used to its fullest capability. You've got, typically the business owner is going to be in their 50s, doesn't have to be, but usually they're going to be skewing maybe a little bit older than some of the other employees. You've got a business, say 50 employees or less. We've seen it work really well in the 10 to 20, 25 range. But even with all that said, you check all the boxes, you've got the appetite to put additional money away. One thing you need to understand is these plans, once you decide to fund them, they've got to be funded on an annual or frequent basis, right? And if the company has a bad year, that plan is still going to be sitting there looking for its cash. Now, if you feel like it will, you can talk a little bit about some of the flexibility that we're able to bake into some of this stuff. But you and I are always really careful when we're working with a business owner to understand, have you demonstrated the ability to fund this thing in the past when it wasn't even on the table? And do you have a reasonable expectation to be able to fund this thing in the future for however long that we set up the cash balance plan? Any thoughts on that?
Those are good points that you're making there, Josh. I would say let's use an example of a 50-year-old business owner. It's a stable business that they find themselves in. They are matured to the extent you say that now, Josh. When you've turned 50, you can say that.
I'm pretty close.
Matured, but they also understand that. Hey, and these are questions to say is Mr. and Mrs. Business Owner. When your feet hit the floor in the morning, are you confident that your results from, let's say, last year will also apply to this year? It's like, well, yeah, barring some unforeseen, global pandemic, let's say. That's something that I'm gonna have to deal with. But more often than not, it's like, well, no, that's a check mark for us, is to say, is this recurring revenue? Is this something that's gonna be consistent? Therefore, that kind of helps us to determine, and even there we'll be conservative as we say, what's the maximum deductible contribution, or what is our suggested contribution? And that is to try to dial it in, build to, tailor it to what the business owner's budget is for that, for the overall entity. And really what we're trying to do there is create for them flexibility. So again, try to answer the question this way. 3 years, I would say, at a minimum. Like, if we're going to do this, let's do it for at least 3 years. Right. 5 is sort of an ideal. Plenty of times down the road, we get to that 5th year, looking into the 6th, we say, you know what, let's keep going. Let's move on. Let's maybe sign up again. And from that point on, I'd say it's more of a year by year occasion. But again, if the majority of the contributions are going to the business owner, and we later have to suspend the contribution, freeze the contribution, or even terminate the plan, which always sounds harsh, but it's not really. Those are some mechanisms that we have, some trap doors we build into the planning to allow for the business owner to exit. But again, the IRS is going to generally look for a 3-year perpetuity of the plan being set up.
Very good. All right. Well, listeners, and particularly you business owners, anybody that has this decision-making ability on a 401k plan, and this sounds like something you discuss further, you can reach out to us. You can call 251-327-2124. Leave a message if you don't reach us there. Plus, you can visit our website at gulfcoastfa.com. That's gulfcoastfa as in financialadvisor.com. And on there, you will find, if you will go to our Business Owner Center, one of the main tabs at the top, you can actually pick the cash balance landing page that we have, and you can peruse a lot of this stuff that we had. Yes, Will.
Josh, it's just occurring to me, somebody's going to say this. They're going to say, yeah, Gulf Coast guys, why hasn't my CPA not told me about this?
This is true.
We've heard that before.
Yes.
And we've literally gone and sat in the conference room with a CPA and looked across the table, and it was sort of like deer in headlights. Looked like, oh, I didn't realize you could do this. Right. I thought they were good because I already put a 401k plan in. And and again, I'm a CPA, so I got to be really careful here how I say this, but it's typical of a CPA you're asking them to look out into the future. You're asking them to say, hey, I want to make a 3-year or 5-year commitment to something. They don't like doing that.
Right.
They're constantly going to be going, well, what if this and what if that? And we certainly take into account those factors. But most CPAs are compliance driven. They want to just finish the tax return and get it out the door. And they're going to come back to the business owner and say, well, I got good news and bad news. Good news is you made a whole bunch of money. Bad news is you're going to have to part ways with a chunk of it. Our goal is to help you save as many of those hard-earned dollars as you can so you can enjoy them later, or quite frankly, build out an abundance fund to give part of it away. In any case, just beware business owners that the CPAs oftentimes will, I think you can do that. And that's really where stepping up to the table. And we love having those conversations to help bring them out of the dark and into the light around what's just possible for the business owner.
Very good. And Will has, with his 20 plus years of CPA background, he has a secret handshake that he can do with your CPA, and they start talking this special language that only they can understand. I was teasing. So yeah, great way to end the show. So anyway, if you all want to reach out, gulfcoastfa.com, you can schedule an appointment there. I want to thank, as always, our wonderful producer, Johnny Gwynn. We're here in Deep Fried Studios, downtown Mobile, Alabama. I want to thank my co-host, Will Steih. And then as always, I want to thank the people that are listening to us, that have been joining us on this journey, on us getting information out, particularly to business owners and folks like that are looking for this type of information. Johnny, we're going to cut that last line. Let me go again. All right. That's a great way to wrap up the show. So listeners, again, if this applies to you, you got the phone number. You can visit our website, gulfcoastfa.com. I want to send I got to get my rhythm down here. Sorry, Johnny. All right. Again. All right. That's a great way to end the show. Listeners, again, if this topic applies to you, if you're interested in hearing more, reach out to us. Visit our website, gulfcoastfa.com. Go to the Business Owner Center. I want to thank our producer, Johnny Gwynn, down here in Deep Fried Studios, downtown Mobile, Alabama. I want to thank my co-host, Will Steih. He has done a wonderful job as always. And of course, we definitely want to send a huge shout out to all y'all that are listening. Those of you that have joined us on this journey, thank you very much for your support. And we're very excited to get this podcast up and running for Gulf Coast area domination. So thank you all. This has been Wealth and Waves. Have a great day.